UCS out with results today, and the IT group's grown revenue 7% for the year to September. Headline earnings a share up 42%, and the group has also announced a 120% improvement in its working capital. Joining me with more is Deputy CEO Dean Sparrow. Dean, thanks very much for coming in today. A strong set of results, but it has included quite a bit of hard work. So you have streamlined the group, you've reduced your exposure to large one-off projects. How's that all gone at the end of the process?
So I think your intro into that was quite correct. There's been a lot of hard work within the group over the last 12 or 18 months, specifically looking very critically at the areas where we had once-off revenues that had a higher risk aspect to them. And we looked to exit those once-off revenue type businesses. The most material one would have been the exit of our enterprise solutions business, which we executed in 2009. And so what you're starting to see in 2010 financial year results is some management around the bottom line impact of what was transpiring in the recessionary climate around the lack of once-off revenue type opportunities. So that kind of work internally together with what we have seen as stabilizing in the retail markets has meant that overall the business is starting to look a little bit more predictable in terms of its annuity revenue streams and its outlook going forward.
And of course, smoother revenue going forward from this stage as well.
That's correct, yes.
So talk to us about the changes in the US, because US Solutions Incorporated, you've sold that or you've moved away from that. The rationale for that?
So it is tying back to the previous theme, which is around looking very critically at once-off type revenue aspects within our group. The UCS Solutions Inc. business was very specifically a UCS Solutions SAP solution that we were offering in the US. It was predominantly a project-based operation, and we had estimated that the project-based nature would evolve over time into annuity revenue. As we deployed projects, we would then move into an ongoing support and maintenance type arrangement, which is very similar to our current South African operation in that respect. Unfortunately, in the US, the conditions are slightly different, the market is slightly different, and in fact, we've now to date successfully deployed about 3 or 4 projects in that market, but neither of them or none of them have actually evolved into an annuity relationship with those respective clients. So for us, from an overall risk perspective, our view is that if we're not in the businesses that are going to have an adequate balance between annuity and once-off, it's preferably a business we would not like to be directly invested in. But that doesn't mean to say we're not attracted to the channel opportunity it represents. So the disposal of our interest in that business was then substituted with a reseller arrangement with the business going forward, whereby the business will continue to offer our particular intellectual property in that market insofar as the retail SAP all-in-one template is concerned.
Now you have quite a big exposure to the retail sector through point of sale, yes, software packages, don't you? How are you seeing it at the moment? Because I would assume it's doing pretty well given the results we're seeing now.
Yes. Look, yeah, to be honest with you, during the course of the year, it's been very up and down. You know, we saw a bit of, I'd almost say, an artificial demand driven ahead of the FIFA World Cup time period domestically. And we benefited in that respect in certain of our businesses, particularly our businesses focused on the hospitality component of retail. What we see now is some more kind of consistent signs of stability emerging, and we're definitely seeing some of the retailers coming out with more positive results. And all of that obviously ultimately underpins more positive sentiment around particularly the investment cycles that a number of retailers have actually put on the back burner for the last year or two as they've managed through the more turbulent conditions. So we think what that bodes well for going forward is more positive sentiment around investment within the broader IT infrastructure, which is essentially the UCS's niche focus.
And I suppose you really are dependent on store rollouts from shop retailers, from fast food franchises and things like that.
That's correct. And we've seen a number of those accelerating. We've seen, particularly in a food retailer in the last 2 to 3 months, somewhere in the region of 40 to 50 stores being rolled out, both locally and up into Africa. And we've seen a number of other kind of in-store replacement cycles starting to take place. So a number of the deferred projects that retailers had elected to almost stall 2 or so years ago is very much coming back on stream at the moment.
Well, what's your pipeline of business looking like at the moment, Dean?
We found that in our last quarter of the 2010 financial year, particularly on our services business, that the pipeline was looking far more improved. And that we also found that the actual delivery of projects was far more improved in the last quarter of our 2010 financial year. And given the nature of our business on a services side, to the extent we start deploying projects, then the natural evolution is it rolls into an annuity relationship thereafter. So I think all in all, pretty positive.
How are you affected by the strong rand? Because I presume it makes imported products cheaper for customers wanting to buy those.
We actually impacted on the strengthening rand in 2 areas. One area would be around historical investments we've made offshore at a higher rand rate, and obviously, unfortunately, the implication of a strengthening rand is an unrealized forex loss when we mark to market those investment positions. So that's the one area. The second area, more from a trading point of view, is that we do source certain products internationally, dollar-based, and we apply our fixed margin on those dollar-based products. So in the South African context, when your rand is strengthening, your GP profitability from an absolute rand value perspective is actually under pressure. And we've seen that in 2010.
Take us through the divisions, because you've got three main divisions. Retail appearing to be doing very well. We've spoken about that.
Yes.
Software, less so.
Yes, look, the software division performance is largely impacted this year by the fact that we reacquired a business that had been unbundled out of the group 3 years ago, a company called Agility. It was part of a stated strategy that we came to the market with at the end of last year, where we said we wanted to bring that business back in, and we wanted to work on restructuring it into a more enlarged software business where we would position all of our intellectual property assets around the software offering for retail in one single trading entity. That business came in on the 1st of June of this year, and it negatively impacted us for the balance of our financial year, as it was a loss-making business in its own right. We also invested behind a business that offers a warehouse management solution on a software as a service basis, and it's very much a business that's in the process of commercializing. So it's in the process of ramping up its annuity revenue base, and the impact of that obviously is it has a fixed cost base that needs to be recovered before it moves into positive territory. So those two were probably the most significant impacts from an overall profitability of the software business, together with the fact that we generally did see a lower sales appetite in our software business in the previous year.
I see you're also looking at more strategic partnerships in Africa, installing in a number of other African countries. So you're now present in 8 African countries. What's the scope for growth in Africa for you?
So at this stage, what we're finding is, particularly the 4 strategic partnerships we've been able to sign up in more sub-Saharan African territories has been around the fact that our retailers, local-based retailers, in their growth plans into Africa are looking for their IT support provider to come along with that growth. And what that does mean is we need to position appropriately in certain of the countries. I think it bodes well in terms of, let's call it medium to long-term growth opportunities for the group, because as we position in those respective territories and we work alongside our respective existing customers, we have the opportunity to grow with them as they go up into Africa.
It takes a bit of investment at this stage of the business.
Very much so. Yes, very much.